Hey everyone, welcome back to Lunch at the Markets. Today we are selling everything. Okay, not everything, but just about. Seriously, we are almost indiscriminately selling across the board. Doesn't matter what sector it is. If we're up, if we're down, we are taking risk down. Why the drastic action? Well, when the market was at 1360 in the S&P a week ago, we should have basically last Tuesday just taken the whole book off the table. We were in pretty good shape on the year, and then all of a sudden, Akamai, Molycorp, Goldman Sachs, that pretty much turned the year around. So we're basically finding some religion, right? Basically, when you get to a point where the trading has got really difficult, a lot of times it's very helpful to just clear your screen, start over, and focus in on your best ideas. Okay, so that's basically what we're doing today. We're not telling you to do a dang thing, but we are simply telling you what we've done. So here's some statistics to back up why we made such a drastic move. Take a look at last year. The S&P 500 traded at 1218 on April the 30th. It then bottomed out on July the 2nd at 1023. You're talking about an almost 200-point drop. And I know we've been talking endlessly about sell in May and go away, seasonal weakness, why we don't like the market. But frankly, the hedges that we had on just weren't big enough to compensate for the exposure that we had to this market. And so the reality is that you have to either increase the size of your hedges or take down your bets. We've chosen to take down our bets, which will make our hedges much more effective. Look, there will always be a stock to trade. Okay, there's always going to be a move up or down. There's always going to be a big move. There will always be quarterly earnings reports every quarter. And so basically, in the absence of earnings, what we have seen historically, at least over the past 2 years as we've been laser focused in on these, is that in between earnings seasons, we tend to see the stock market trade down. That's exactly what happened after last year's earnings season, right after April. We made it all the way till about May the 1st, and then boom, stock markets look terrible. April the 30th last year, and the market has looked terrible ever since. If you take a look at the chart of the S&P 500, literally as soon as it hits May the 1st, it looks pretty nasty ever since May the 1st. Okay, there is a line that actually has been in place since the July 2nd low of last year. And it looks like it puts the support of the S&P 500 index at 1320. Now, in true technical fashion, we actually traded down, tagged that 1320, and then traded back up again today. The reality, though, is we've made lower highs and lower lows ever since May the 1st. And I don't know if that 1320 holds. I certainly don't want to stick around for another 200-point drop in the S&P 500. In fact, if you take a look at what happened after January earnings ended somewhere around the first or second week of February. And then from about February let me see if I can get the date. It's around the 15th. We traded from 1344 in the S&P 500 on February the 18th down to 1246 on March the 16th. Guys, that's a 100-point drop in the S&P 500. Now, we've already seen about 40-point drop, but the reality is that I'm not going to stick around for another 60 of them, okay? So, again, we're not taking absolutely everything off the screen. Take, for instance, our trade yesterday in Total. That's performing quite nicely. Total is actually up on the day when clearly the rest of the market is not doing as hot. If you really do your research, if you really zero in on the opportunities, you take a look at your charts, that's really been the missing piece, that we need to pay more attention to the charts, to the technicals. The reality is this is a very technically driven market, and we are seeing, stocks bounce off support, and we're also seeing them fail at resistance. When I take a look at a 10-day chart of the S&P 500, we've failed a couple times at the 150-day moving average. Okay, when you zoom in there, right, the 150-day moving average has actually been above where the S&P 500 index has been, and we've tagged it and then traded back down. So we'll see if we hold on a technical basis the 150-day moving average, from the other side. It's yet to be seen. But for now, we like in-the-money calls. It's a great way to get great exposure. Yesterday, we went through the math of what it would take to gain $900 off 100 shares of Total versus what it's going to take to gain $900 off a 5-lot of in-the-money call spreads on Total. So you're taking massively reduced risk You're already in the money, so the hard work has already been done for you, and all you need is for the stock not to go down a certain level, as opposed to needing the stock to rally X number of dollars in order for you to get gains out of them. So we like the in-the-money call spread. We continue to like that as ways to play it. We'll be coming out with more and more in-the-money call spreads as we do our homework and we zero in on the names that we like the most and our trades that we like the most. So you want to go out 3 to 4 months on an in-the-money call spread. We're also going to be taking a look at selling put spreads, probably a little further out on the curve, but then further down on the curve. So again, it's all going to be as a result of the chart work that we're going to be doing. We're going to go through a ton of charts. I know Jim likes to do that. Every Saturday he gets all the charts and then he goes through them to see what the best ideas are. If you see a chart that just looks absolutely terrible, take a research in motion. We're going to come in from the short side and we're going to play a lot more in the money put spreads in terms of being long in the money put spreads. So the reality is, get those ideas that are in the periphery off your screen. Take your losses or your gains on those names that you've really either been, lucky long enough to be okay on the position, but you really don't have that kind of conviction. Get it down to just those ideas that you have conviction in. Be careful out there. Make sure that you're hedged enough, okay, so that if you see the market go against you, that you really aren't going to take the kind of hits that you don't want to take, okay? You don't want to look back and see that you have a gain and then find out that you didn't take, what was a gain, right? You don't want to snatch victory from the jaws of defeat, all right? Actually, you don't want to snatch defeat from the jaws of victory, right? When you've got a big winner, when you've got a great trade, make sure that you take it off. You probably need to speed up your trading a little bit in this environment because it's very, very choppy out there, and the chances are you're going to get a second and third and fourth time to make that trade that you've got on right now. Thanks for joining us again today. Have a great day, and we will see you tomorrow.